So I took a look at the 10 worst performing stocks of 2025. This is something I like to do from time to time because there's nothing I love more than buying a great company at a great price. And when I find something that the market has unfairly beaten up, that gives me a huge buy opportunity. It's how I've made some of the best buys in my career as an investor. So we'll take a look at some of the worst performers in the S&P 500. And then our second story today will be the perils of AI circular financing. This is a fascinating article and research report that I found from Barron's. It talks about how the house of cards of this AI game could be collapsing. So I definitely recommend you stick around for that. But let's get into our list. Okay, starting off at number 10, we have a company called FactSet, which is down 41% year to date. FactSet is an American fintech legacy company. It competes with like Bloomberg and S&P Global. Market cap's around $10 billion, and the PE ratio is around 17 right now. And revenue has been growing at a pretty reasonable rate. It has slowed down between the 9-year compounding rate and the 1-year compounding rate, so revenue is decelerating, which we don't like to see. Net income's been able to grow, but this is the chart that scares me. When you lose almost 5% of your gross profit margin in a single year, that means that competitors are at the gates trying to storm your castle. And that's really a big problem that FactSet has. They've had sluggish new customer growth, specifically when you're looking at ACV or annual contract value. That's been shrinking. And you've had a lot more customer churn than they've seen in the past. A lot of analysts on Wall Street are also concerned that FactSet lacks the AI defensibility of other large data competitors like Bloomberg or Refinitiv. And when you're competing against companies like S&P Global, which is up 49% this year, and seen revenue grow really nicely, but is also seeing a big hit in their profitability, it shows that things are really in flux in the financial data provider space. So that's a space that I don't know too much about right now, so I'm happy sitting out and waiting to see what happens with this. But S&P Global is a company I've been trying to look at for a while. Okay, next up in our Stinky 10, we got Charter Communications. This is a telecom company that provides services like Spectrum. We can see that revenue's been growing kind of flat, 3% over the last 5 years and 0.42% basically flat over the last year. Their margins are under attack. Their book value has been all over the place. Holy cow, they are buying back shares like wildfire though. And their free cash flow has also been jumping all over the place. The basic thing for me in Charter is everyone I know hates Spectrum. But I will never buy a company that every one of their customers I know hates that company. That's not a good horse to bet on. So I'm pretty much ready to say, yeah, I'm not interested in Charter. All right, then next up on our list, we have Chipotle Mexican Grill, which is down 42% this year. I made a post 2 months ago on Flank saying why I'm not buying Chipotle stock, and it's because of this. And I'm being smarmy, but I'm also making a larger point. One of the most underappreciated advantages that we have as regular investors is that we live in the world and we can see the companies that we're looking at investing in and how they're performing in real life as a consumer. And when I got that bullshit chip from Chipotle, it showed me that, yeah, this is a company that is having quality issues. You have a lot of people complaining that if you want to get more meat on your burrito, you have to go into the store and give them a nod, is something that the CEO hinted at. That's not what we want to do. Also, Brian Niccol, the CEO of Chipotle, made the 10 most overpaid CEOs who underperform. In 2022, he was paid $38 million when his average employee only made $13,000. And he hasn't really laid out a good turnaround plan for the company. So this is one I'm looking at, but I need to see quality get better before I even consider taking a position in it and looking deeper at the business and their growth strategy. If they're not doing the basics right, then there's no way they're going to turn around the stock. And we can see this in the performance of the stock. Revenue has continued to grow, but net income is not able to keep up with it, probably due to the increased costs of beef and other things due to tariffs and trade restrictions. But revenue plateauing like that is not a good sign for a company that's a growth stock. I mean, it's pretty expensive to buy the stock right now at 29 times earnings. So this is one that I'm looking at, but I'm not ready to buy yet. Okay, next we have down 45% this year, Alexandria Real Estate Holdings. This company is a REIT, a real estate investment trust, which means it's like a real estate holding company that you can invest in. And they play in a unique space. They develop real estate for collaborative life science and ag tech companies, agricultural technology companies. And a lot of the problems with the company right now is due to reduced life science funding, which has been cut at the federal level. So it makes sense why a company that specializes in giving those places real estate would also be hit really hard. So yeah, that's another one not really interested in. Then you have Molina Healthcare, which was down 49%. Molina provides healthcare, and that's outside of my circle of competence. I am not a health guy, so I'm not interested in it. And that was an easy one for me to move on. Next, we have a company that I hold in my public portfolio, Lululemon Athletica. This stock continues to get the absolute crap kicked out of it. It's down to $22 billion in total market cap, which I kind of like that number. And a PE ratio of 12. That's making me want to hover over the buy button. So I wanted to look at what's going on. And the biggest story I could find is that the former CEO, Chip Wilson, whom we made a video on talking about how he's an uber douche, and I opened up my most recent post on it saying, my opinion on him has not changed. In a recent Wall Street Journal article, it talks about how Lululemon is having an identity crisis and how Chip Wilson may be starting an activist play to turn around the stock and regain its former glory. Chip Wilson is still a major shareholder. He holds around 8% of the total shares outstanding, and he's blamed the new CEO, Calvin McDonald, who took over in 2018, as reason for losing the cool. Now, how can you say this guy's lost the cool? Look at Calvin. That's probably the most handsome CEO in the S&P 500. But that's also kind of Chip Wilson's point, is that he says that the loss of cool at Lululemon is because they lost their identity. They have a CEO who can speak to Wall Street, but is killing innovation. Chip Wilson's basically saying that they're suffering from post-founder syndrome. And he's gone so far and he's so petty that on October 7th of 2025, he took out a full-page ad in the Wall Street Journal to call out a company that he owns 8% of the stock of. And he says, a company bereft of a visionary loses its singular voice for product and long-term strategy, a strategy that builds a moat around success. Oh, he knows how to talk that Buffett language. And the loss of cool that we talked about. And then he basically says Lululemon is becoming the Gap. He's like, why are we selling office wear? We're an athleisure company. He's saying that's because the MBAs are swooping in and there's no risk taking at the company. But to Chip Wilson's credit, he does give a path forward. So he says that he believes that Lululemon can recover, but the survival requires courage. And the 5 recommendations that he makes is put product and brand back at the center. I completely agree with you there, man. As someone who believes in Lululemon, I'm wearing Lululemon right now. I love their clothing, but I've seen a quality decrease. Everyone has, and I don't like it. And then bring entrepreneurial ownership back onto the board. All right, whatever, man. You just want a board seat. Again, I get it. You were ousted. You said something stupid that you shouldn't have said. Basically said that our clothes weren't, basically fat shamed people, saying that their clothes weren't for everybody. And you kind of got to pay the price. And you really pissed off a lot of your core customers. So I'm sorry, man. I don't really care about that one. Empower creative leadership over merchants. Sure, I guess. Stop chasing Wall Street at the expense of customers. Yes, 100% agree with that. And recommit to the muse, the woman who inspires the brand. That last one's a really interesting point, and it's really, to me, the biggest source of tension between the two CEOs' vision. Wilson and McDonald disagree on who the Lululemon muse should be. That's what the Wall Street Journal reported. Wilson wants the company to go back to its root and design for the Supergirl, a young, educated, working woman. McDonald's wants the team to focus on the mindful athlete, a goal-oriented, active people who mix and match athletic and lifestyle apparel. I don't really know which direction the company should go here, but I do know that in any form of marketing, one of the most important things you can do is know who you are selling to. And when you have two major shareholders kind of arguing on who are we going after, that does create friction. And then final news from Lululemon, they have a new creative product director, Jonathan Chang, coming in. It's going to be very, very important to see what he does and the new products they bring in. Calvin vowed to boost new style sales to 35% of the company, which it's currently at 23%. Basically, the complaint there is that their styles are becoming stale, like their scuba sweatshirt and some of their leggings. So Calvin McDonald's saying there that he's going to innovate their products, and they'll sell more of those new products, up to 35% of them. So overall, I'm neutral on Lululemon. I currently hold it, but I kind of see it going either way. It's a little risky right now. I do love the price it's at, and I do believe in the long-term vision. So it's one that I want to see more updates come from the company on how they're going to turn things around. And the pressure from ALO and Vuori is really, really fierce, and it's getting worse. And then you also have companies like Quince and stuff coming in that are just giving it way bigger discounts. So selling $100 leggings is getting harder and harder. Okay, and then at almost 50% down this year, we have Gartner. If you don't know what Gartner is, it's basically a research and advisory company that will rate B2B software companies. Like they have the Magic Quadrant, which is a common thing where they rank, how well, if a B2B product is a visionary or if it's a challenger or just, they give that kind of insight. And the reason why the company's been completely hammered kind of makes sense. It's because a lot of the research that Gartner currently provides can be done with AI. And they haven't found a really good story to tell us how they're going to protect against that. And they've also reported weak forward bookings. So this is one that unless they are screaming what they're doing to prevent AI from completely destroying their business, I'm going to sit this one out. I'm not too interested in them. Okay, now we're getting into the juicy ones. Deckers. This one was surprising to me. Deckers is responsible for 3 major brands: UGG, Teva, and Hoka, which I thought were three really well-selling footwear pieces. I mean, everyone I know wears Hoka, and that was one of the reasons why Nike's been dragged down so much, is because Hoka has been taking over. But then I remembered that we don't make a lot of shoes in the US. We make them in countries that are now being tariffed. And there are some signs that there's some cooling consumer demand in Hokas. So really the big question here will be, how can they get around tariffs? So what does this macroeconomic picture look like moving forward? And then second, are Hokas going to still be as popular as they have been over the last 3 years? I think they're uglier than sin, but I know a lot of people, including some people very close to me, who freaking love them. And right now the data is telling us that they are kind of holding. I mean, we can see that gross profit margin's kind of jumping all over the place, but when you look at it, the 30,000 view, we are seeing some expansion. The last 9 years, they've had a 2% expansion in margins. 5 years, they've been averaging a 1.89% per year, and then 0.46 over the last year. So it doesn't really support that competitors are starting to eat down. But me personally as an investor, I'm going to start stepping away from apparel brands. Here's Buffett and Munger on apparel brands.
So you're really asking about the future prospects of Nike and Reebok? Yeah, I don't know that much about those businesses. We do have one person in this audience at least who owns a lot of Reebok, but I'm not expressing a negative view in any way on that. I don't understand I don't understand their competitive position and the likelihood of permanence of their competitive position over a 10 or 20 year period.
This is kind of the problem with apparel brands I'm realizing, and this is why I love investing. Even though I've been doing this for over 10 years, I'm still learning things all the time. But apparel brands fall out of favor so quick, it's hard to catch it unless that's all you do is study fashion, which if you do study fashion, I think you'd be a better investor in these companies than a Wall Street analyst because you can see the trends happening before the street does. But I'm not that person, so I'm going to try backing away from apparel companies moving forward. I will be holding on to my Lululemon position, but I'm not interested in Deckers. Okay, now we're getting into the big losers. So this is Trade Desk at number 2 at losing 66% over the last year. And this one's weird. Look at this company. I mean, 36% 9-year growth, 30% over the 5-year, and 20% over the last year. I mean, that's a beautiful revenue graph. Absolutely gorgeous. Some compression in their margins. Okay, sure. Net income's going pretty well. This is surprising. A little bit of dilution, a lot of dilution over the long term. But yeah, this is a company that should be doing pretty well. So I kind of wanted to figure out what they were. I know I've heard of them before, but I wasn't sure exactly what they did. Basically, Trade Desk is a global advertising company that offers full self-service, cloud-based platform for ad buyers to plan, manage, optimize, and measure data-driven digital advertising campaigns. So it's an ad tech company. And just to show you what Gartner actually does, so I wanted to see how ad tech companies work. I've never bought an ad, so I didn't really know how to analyze this. But then when I looked at which companies Gartner recommends for ad tech companies, the number one is the Trade Desk. And then you got a company Basis, which I mentioned, which is a startup, and then MediaOcean. But then things got scary for me. Then you have Google Campaign Manager 360, Adobe Advertising. You have some big names coming in, and they're competing with some serious companies there. Google has a digital marketing platform. Adobe is also breaking into it. Amazon is going into the advertising space. So these are like some of the largest and most innovative companies in the world. I have no idea if Trade Desk can outsmart them. No idea. So Trade Desk is a company that I'm going to be staying away from because it's not in my circle of competence. But if there are any marketing people in our community or who are watching this, come on to Flank. I'd love to see your analysis on Trade Desk. I'll research it with you, or at least I'll read your research and provide you any feedback for things I disagree with or don't understand. Because this could be a buy, but I just don't know what Trade Desk is. I don't know how the advertising space works. Okay, and then our biggest loser for 2025 is Fiserv, which is down over 65% this year. I actually wrote an article 4 weeks ago talking about this company. What I didn't understand was basically growth has stalled with this company, and then they've also had major leadership changes, a new CFO, new co-presidents, and some changes to the board. But when I looked at the company, it looks like everything's going really well. Some margin compression over the last year, but over the long term, it's been good. Book values screamed up. It looks like a good company. They're buying back stock like it's going out of style. It looks like a good business. But then I had to think about it, and I was like, well, what do they even do? and it's a fintech company. They own Clover, the point of sale machines that you sometimes see at stores. And that's another one where competition is just getting crazy. You have intense competition from Stripe, Adyen, Square, Block. There's a lot of companies that are competing for the point of sale and for the merchant services segment. Just like we saw PayPal. We talked about that last week, where PayPal's also under a lot of pressure right now. And when it comes to these smaller companies, like a $34 billion company, but then you're going against Stripe, which has hundreds of billions of dollars in valuation, you don't really know what they can do to beat them. So again, this is another one that I would put in my too hard pile because I don't play in this space very much. But if someone does know about fintech services as it applies to Fiserv, then I think this could be a company that definitely warrants for looking at closer. Okay, then the last story I wanted to get to, and I thought this one was just really, really interesting. And it's talking about the perils of AI mega deals. So we've all seen this chart talking about how NVIDIA is like doing a bunch of circular financing, right? Everyone's seen it. Every article and video I've seen about this basically says, yep, we got to wait and see. This is probably not good. It's probably indicative that we're nearing a peak, but there's nothing we can do about it. Like Michael Burry even tweeted it to show when he announced his shorts for Palantir NVIDIA. So so everyone's talking about it. But then I read this fantastic article from Randall Forsyth in Barron's this week. And then he talks about how these AI debt mega deals are really important. And a lot of this piece comes from a BCA research article that came out earlier this month that talks about exactly this. And what it does is they look at 5 other CapEx booms: the railway boom of the 19th century, the electrification boom of the 1920s, and the internet boom of the late 90s, and they extract 5 lessons from that. Just so we're all starting on the same playing field, what a CapEx boom is a period in which there's a large investment in capital expenditures. Capital expenditure is basically just funds that companies use to either to buy, upgrade, or maintain physical assets. And so when we're talking about AI, we're talking about all the data center buildouts that are happening. Remember, to answer a simple AI prompt requires a lot of electricity and a lot of compute to do so, especially when compared to a normal like Google search. Or another example of a capital expenditure would be if Tesla made another gigafactory. I won't go through each story. You can check out this post on Flank by visiting flankinvesting.com. You can access it for free. But basically, that research article looks at the electrification boom of the 1920s, where you had 8% of all homes being electrified in 1907, all the way up to 68% by 1930. And Wall Street went crazy over the electrification buy until it crashed, which actually resulted in the 1929 stock market crash. And same thing for the internet boom. There was huge capital expenditures happening for the internet build-out in the late 1990s. So much so that tech-related CapEx spending was 2.9% of total GDP in 1992, all the way to a peak at 4.5% in 2000. For context, KKR recently wrote in a post that AI-related capital expenditures are accounting for about 5% of GDP. So we're getting close to those same historic levels. And the same thing happened in the mid-1800s when railways were the big hot thing. By 1847, railway constructed exceeded 7% of British GDP. And then by the end of that decade, the railroad stocks had fallen 65%. And the same thing happened in the US around that time. So what do we do about it? The punchline of it was the 5 lessons learned. I want to cover those a little bit more in detail. So lesson 1 was investors failed to appreciate the S-shaped nature of technological adoption. We've talked about this one a little bit, but you can basically see here in this chart that AI adoption is slowing a little bit. That's the S shape right there. It's starting to slow across even small, medium, and large businesses. And we've talked about Amara's law before, which basically says that people overestimate the impact of new technology in the short run and underestimate it in the long run. And this S-shaped curve is basically just another way to say that. And then lesson number 2 was revenue forecasts underestimated the degree in which prices would fall. So internet traffic grew at 67% a year from 1998 to 2015, but the price of transmitting that one bit of information drastically fell. You can see right here, U.S. internet transit prices completely plummeted over that time period. And they're basically saying that could be what's happening with AI. When we saw that earlier this year when DeepSeek came out and shocked the markets, if we get more efficient at our AI compute, then we don't need these massive superclusters and AI data centers. So I think this is actually the biggest risk, and price deflation could be the straw that breaks the camel's back and pulls the bottom out from underneath us. Which, if you've been following Flank for a while, you know that is exactly what we hope happens. The stock market is the only store in the world in which when things go on sale, everyone runs out of the store. But we don't do that at Flank. We flank that shit. Lesson number 3, debt became increasingly important source of financing. Dun, dun, dun. This is exactly what we're seeing in the AI world. So early on, AI capital spending was financed by the companies themselves. But then in the last couple of months, that's completely changed. In October, Meta announced a $27 billion data financing deal, which they're housing in an off-balance sheet item in a special purpose vehicle. Do not love to see that. That's freaking sketch. And then Oracle tapped the bond market for $18 billion. We're also seeing credit default swaps, which is basically insurance for creditors in case their debtors are unable to pay. But those credit default swaps premiums more than doubled for Oracle since September. And CoreWeave's credit default swaps also gapped higher this past week. So the debt is getting more and more expensive. Not good to see. And you can see in this chart that debt is being increasingly used to finance AI CapEx. Specifically, it's up from about $8 billion in 2024 to over $13 billion in 2025. So it's jumping pretty quick. And then lesson 4 is asset prices peaked before investment declined. That's basically saying that estimates are going to fall before the actual CapEx spending declines. So we, as investors, we should just be looking at how this investment super cycle is playing out. That was kind of their weakest point, in my opinion. But then lesson 5, the CapEx bust weighed on the economy, which in turn further hurt asset prices. What they're saying here is something we kind of all know. A lot of the gains in the S&P 500 this year have been a result of AI. There's no question there. NVIDIA surged to be over 8% of the S&P 500 and has a valuation of over $5 trillion. But when these asset bubbles do break, then the whole market's going to get brought down with it. Again, hopefully that does happen. Hopefully it happens soon so we can go on a buying spree. But it's a really good point, that saying that, hey, this stuff will have broader impacts when it actually does happen. We've talked about it before, but what I'm taking away from all this is I'm just shifting to be more defensive right now. My portfolio, I already hold a lot of T-bills, so I'm ready to deploy capital. I got a lot of dry powder right now. But then I'm also looking at investing in a grocery store down the street from where I live, which I've talked about on this channel. I'm looking at buying Berkshire Hathaway. I'm looking at buying a coconut water company. I'm looking at things that are simple and easy. I'm not trying to play 3D chess right now, especially when the temperature is so hot. That's all for this episode. If you want to see more on my research and see it as it comes out, be sure to join flankinvesting.com. You can do so for free. And the purpose of flankinvesting.com is to make you a better investor. And the way Flank makes you a better investor is through our Flux program. Each day you automatically receive 1 Flux. I'm on a 4-day streak, but you can see, so I've already given mine for the day, but that's what it would look like if I hadn't yet. And then you want to give a Flux to a post that sparks your curiosity, or just taught you something new, or made you think about a new investment differently. Anything. Today I gave mine to Phil Fisher because he wrote a really interesting piece talking about AI compression, which is important for the reasons discussed above with the AI CapEx spending bubble. So I gave him my Flux, and he actually got money for that. You can see I've earned $60 since this feature was released a couple months ago. And if you go to our leaderboard, Phil Fisher's also earned about $55. So not only do you reward other people for their analysis, but then you also get paid for writing your own analysis, which is the number one thing you can do to become a better investor, is actually put your thoughts down, give them legs. Not only so other people in the community can comment and help you out and try to see your blind spots, but also so then in 2 or 3 years, you can see what you were thinking and you can get better as an investor. It's what I've done for over 10 years, and that's why I created Flank. There wasn't a good place to do that anywhere on the internet. And looking back at your theses and what the heck you were thinking when you buy things is a really great way to become a better investor. And if none of this makes any sense to you, then you're in luck, because we have a Learn program in which we show you exactly how to research stocks like Warren Buffett, and the first couple sections of the course are completely free. So I hope to see you over there at flankinvesting.com. If you do join, make sure you say hi. That's all for this one. Thanks so much for watching, and we'll see you in the next one.